This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
I'm on June 2013 F7, question 3, called Monty. And it's, let me see what it is. Prepare statement of cash flows. Indirect method. It always is the indirect method. He's never asked to prepare using the direct method. The only time he's mentioned direct method is when he said a 5-mark part B. It said if direct method is the benchmark, why do most companies use the indirect method? That was the 5 marks. Anyway, this one is developing into, your examiner is asking more and more a commentary on performance or financial position. This time is specific in terms of return on capital employed, profit margins, asset utilization and gearing, and 4 marks are available for the calculation of the ratio. So it's looking for 6 marks worth of commentary and 15 marks for the cash flow. If it's only 15 marks, it's not a 25 marker on cash flow. So it should be a relatively straightforward cash flow question. The notes to the cash flow, I'm not looking at the figures. The notes to the question: on the 1st of July, acquired additional plant under finance lease, had a fair value of 1.5. Also revalued property upwards by 2 million and transferred 650. The resulting revaluation reserve is created to deferred tax. There were no disposals of non-current assets during the period. Depreciation of property, plant and equipment was 900 and amortization of the deferred development expenditure 200. So you see, it gives you 2 figures from the cash flow, the depreciation and the amortization. Both of those figures will appear in the operating activities section of the cash flow. So let's have a look at the question. Statement of cash flows using the indirect method. Admin loan interest, lease interest, profit before tax is a start point. So I need to then add back the loan interest and the lease interest. There's no, looking at the current liabilities, there's no interest, loan interest, nor finance lease interest outstanding brought forward, nor outstanding carried forward. The other interesting thing here, and it's unusual for him, is that the bank figure is positive in both years. He normally changes the sign, but it's 1,300 brought forward and 50 carried forward, and there's no sign of any cash equivalents. So right at the bottom of the question, this is the bottom of the question. I'm going to do the bottom of the question first. Net cash flow for the year, we don't know, but we do know cash and equivalents brought forward is 1,300. And when that is added to cash flow for the year, that will give me cash and equivalents carried forward, and the figure is 50. Therefore we must have made 1250 loss, or net outflow for the year, in order to arrive at those bottom 3 figures. Now whatever happens, those 3 figures are right. We know that those are right. So whatever our additions add up to, we do not change those 3 figures, because they have to be right. So I'm going to get rid of it now because that's at the bottom of the answer. So let me see what people are trying to be contacting me apparently. No, don't matter. Right, so PBT. PBT is messages coming through, I can't believe it. All the inboxes. No, nothing worth interesting. All right, PBT is 3,000, and we need to add back to that add back the loan interest and lease interest. And that's 150 and 250. And we're going to add back also the depreciation and the amortization. those are given to us as 900 and 200, because those are not cash, those are non-cash items, so those need to be added back straight away. And then we can think about change in working capital. What have we got? Inventory. Inventory's gone down. A decrease in inventory is 500. Now then, the question is that 500 in brackets or not? Is it an outflow or is it an inflow? If you think in terms of I started with 10 and I finished with 12 and I've not sold any, then I must have bought 2. So an increase in inventory is an outflow of funds. This time it's a decrease in inventory, so it's an inflow of funds, so it's a positive figure, it's not a negative. Receivables, they've gone up as well. Increase in receivables has gone up by 750. Now again, think in terms of your friends didn't owe you any money, and then you lent them some money, you lent them 750, so your receivables have increased by 750. But what's happened to your cash? Your cash has gone down. So an increase in receivables is a negative cash flow. And same with the payables. What have we got for payables? That's an increase in payables. You're the one who's borrowing the money. The figure here is 550. You're the one borrowing the money, and therefore your payables have increased by 550. So that's an inflow of funds. That deals with those. Then we need to know about the interest, tax and dividends paid. Interest actually paid. Well, we don't have any indication on the balance sheet, on the statement of financial position, of any accrued interest, neither brought forward nor carried forward. So we must assume that 150 is actually being paid. And same with that's the loan. Same with the finance lease interest paid, that's 250. Again, we have no indication of any accrued finance lease interest. Dividends, these three, interest, tax, or tax paid. Tax paid. We started with, we got 2 lots of tax, haven't we? If I just do a simple T account, we started with an 800 liability and a 725 liability. Both of those are brought forward. And we have a carry forward of 1500. And a carry forward of current tax payable 1250. And we're told that there's a transfer on the revaluation. We revalued according to the question, we revalued by 2 million, and the revaluation reserve is only 1350. So there's my PP. I'm going to rub this out in a second. There's my PP, there's my revaluation. And I've increased my PP by 2,000 and credited revaluation. And then I've taken 650 of that and put it into the deferred tax account. So I've credited the tax figure. It doesn't matter if it's current or deferred in this particular question. So that then gives me, what does that give me? 2175. And that's 2750. So the difference of, I've got the income statement as well. Income statement charge. Income statement charge of 1,000. So that's 2175, 3175, which means I must have paid cash of 250, 350, 425. I must have paid cash of 425 tax. You can do, on a cash flow question, you can amalgamate all the tax figures, the same as I'm going to amalgamate all the finance lease figures. You can amalgamate them into the one account, because we don't have to do this element that we had to do in question 2, where we had to work out what the deferred tax transfer to the current tax account was. But in a cash flow we can just put all the tax figures, I'll just head it taxation, we can put all the figures into the one account. So I'm now going to get rid of these little workings here. Those you would show separately and neatly somewhere on your answer page, but I've got the tax figure. Now this threesome, up here we've got a threesome of depreciation, amortization and impairment, because they're all non-cash items. Then we've got another threesome, inventory, receivables and payables. And now we have another threesome, which is interest, those first two, tax and dividends. But there's no indication of any dividends. There's no mention of any dividends within the question. But if you look at the retained earnings brought forward, 1750, and the retained earnings for the year, which is 3350, then you would expect 5100 to be the retained earnings figure carried forward, but it's not. The retained earnings figure carried forward is 32. So there must have been a dividend payment. Now then, is that 1900? It looks like it. Dividend paid. I may need to look again at that, but I think I'm okay on that one. Now, is there anything else? Are there any warranties or anything like that? I can't see any. No, I should be alright on that, 1900. Okay, we need to add this up. Well, in an exam, I would add it up by all means, but I wouldn't put the figure here. I'm going to on the basis I can easily rub it out, but I wouldn't do it there. So that's 4, 5, 6, 2000, 1800, 1800 minus 1400, 975, 925 negative. I'm going to put it there, but I may be wrong. It may need to be adjusted. We'll have a look in a second. Now I've got the investing activities. Proceeds of asset disposal. No, there aren't any. We've not sold any assets. But we do have investment in development expenditure. Development expenditure. There was none brought forward. There is 1,000 now, but that's after 200 impairment. So we must have spent 1,200 on development expenditure. PPE will need a separate working. Again, I'm going to show it on here and then I'm going to rub it out. But PPE, I would have as a separate working. 10,700 was the brought forward, and we've depreciated that by 900. So 9,800 is the PP that we started with, and we still have, and we have not got rid of any. But we did revalue by 2,000, so that gets me up to 11,800. And we also bought some finance leased assets. That gets me to 13,300. If there had been any disposals, they would have come off that 13,300. And we've got 14,000 assets at the end of the year. Therefore, we must have spent 700. We must have spent. That's brought forward, depreciation, revalue, finance lease, carry forward, therefore cash must be 700. I'm going to take all that out now. You can pause it, obviously. Windows, oh, my Windows has stopped working. Oh dear. Save changes to my note. Okay. But Windows Journal has stopped. Oh, Lord above, where did I get to with that? 4, 5, 6, 2000, 1800, 1400, 975, 925, negative. I think I've got it all in. Investing activities, development expenditure. I think we'd already worked that out as 1,200, haven't we? It's in there still at 1,000, and we have amortised. Purchase of TNCA. What did I work that out at? That was 700, wasn't it, from memory? So that's 1,900. I'm not happy about that dividend, but anyway, it seems a big dividend to have paid. Financing activities. Have we issued any shares? Nope, we've no share issue. Retained earnings I've dealt with. Loan, we've got a loan repayment. That was 1,725. That's 3,125 minus 1,400. I suppose really I ought to put that in. What else have we got? Financing activities. We've dealt with deferred tax. No, finance lease creditors. How much have we paid them? Well, we've dealt with the finance lease interest. If I have my finance lease creditors, I've got two figures brought down. I have 900 and 600. And carry down, I've got 1,200 and 750. And I know that I've bought an asset under finance lease of 1,005. That gives me 3,000. 3,000. That means I must have paid 1,050. I must have paid that because I've got the brought forward figures, I have the carry forward figures, and I know that the obligation is increased by 1,500. So I must have paid 1,050 to the finance lease creditors. So I'm taking that away, get out of the way. You would have written that on your answer book in a nice working. 2,875 negative. So where does that put me? 3,000. That's 2,825. That's 175. 3,050. Is that right? 2,875, 4,775, 4,75657. No. 925. 384857. 57 and 3,000 is 27. Is that right? You check my calcs, will you? You check my additions. And I've got brought forward cash of 1,300, and I've got carry forward cash of 50. Therefore, that figure is wrong. That should be 1,250, so I'm 1,450 wrong. I'm just going to check my additions again. 456 2000. Yeah, 1,800 minus 4 is 1,004. 975. 975, 925. 1,900. Agrees. Two seven seven five, not 2,875, 2,775. So that brings that down to 2,6, and it should be some 1,250. I think it's that dividend. It is. You stupid man. You stupid man. The dividend, retained earnings brought forward, is 1,300. Is 1,750. For the year is 2,000, not 3,350. That gives me 3,750, and a carry forward of 3,2. That means I got 550 dividend, not 1,900. So yet again, I'm going to add this up. 4, 13, 14, 15, 2,000, 1,800, 1,400, 975, 975, 425, and it's positive. 425 positive. So 2,775, 425 is 2,003, 3,003, 4,002 for the 1,200. That should be 1,200, and that means I'm 50 wrong somewhere. Alright, one more time. Just let me check it through. I still should be within my time allocation. Profit before tax is 3,000. Loan interest in that add back, yep. Depreciation 9 and 2 are given. Inventory is down 5. 750 increase in receivables. Payables 550 increase. Deduct those payments. Deduct the tax payment. Just let me work the tax out again. 8 and 725. Tax for the year is 1,000. That's 25.25. Deduct the carry forward tax. If I had paid all my tax, I would have paid 2,525. But I know I haven't paid it all because I still owe 1,500. I still owe 1,250. So it's 2,750. I still owe how much? 1,500 and 1,250. 800 and 725. 2,750. Michael, where have you gone wrong? Where have you gone wrong? 8, 725. 1525. Okay. Tax. DT. I say you didn't have to do this. You didn't need to do it. But I've gone wrong somewhere. 800 brought down. 1,500 carried down. Oh, we got a 650 transferred. Stupid. Current tax brought down 725, carried down 1250. That balances off at 50. That gives me, that's for the year. That's 1725, 1725, 1,300, 425 cash paid, which I think is what I got in the first place, isn't it? Tax paid. 425, yeah. Okay, so I'm happy with that. So the tax figure's okay. What else have I done? Tax paid, dividends paid, I've just recalculated that. I'll do that again. 1750 brought forward retained earnings. Retained earnings for the year 2000, that's 3,750. Retained earnings carried forward 3,2. So 550 must be the dividend. Okay, I'm happy with that. Yeah. Happy with those three, 500, 750, 550. Alright, let me check the addition one more time. 4, 13, 14, 15, 2,000, 1,800. 17, 16, 15, 1,400, 1,000, 975, 975, 475, 425. Yeah, I'm happy with that figure as well, 425. Development, I'm happy with 1,200. Purchase of TNCA, think I need to do that one again. I'm quite happy with that as well. 1050 and 1735, that's 172775. Okay, let's do it again. 3425. 1525. Yeah. 1250. Just stupid addition mistakes. But that's the cash flow. How long did that take me, including chasing around? 1432. That's taken me 25 minutes. It's 15 marks. That's a 27-minute question. So I'm still ahead of time. Now then, let me get rid of that. Now, comment on the comparative performance of Monty in terms of capital employed, total assets less current liabilities. We're not really using the deferred tax. Deferred tax is not capital. I think I'm going to miss the deferred tax off my capital employed calculation. So my return on capital employed is profit before tax of 3,000. Profit before interest and tax, PBIT, over total assets less current liabilities, but I'm going to not take in the deferred tax because that's not really capital employed. So profit before interest and tax is 3,400. And total assets less current liabilities, but adjusting for that, that's 15,150. Now that's made up of 12,550 plus the 8% loan plus finance lease obligation. So that's 14,150. That's where that figure's come from. And that works out to be, with my trusty calculator, 3,004 divided by 15,150 is 22.44%. Where last year it was 9,750 plus 3,125 and 900, which is 13,775. And profit before interest and tax was profit before tax 2,400. So that's 2,400 divided by 13,775. 2,4 divided by 13,775 is 17.4%. Okay. Gross profit percentage. Gross profit percentage is 9.2 divided by 31. Compared with 6.4 for 25. 9.2 divided by 31 is 29.7, and 6.4 divided by 25 is 25.6. Oh, that's a nice improvement. The improvement is 4.1 divided by 25.6. which says an increase of 16%. 16% of 25.6 is that difference. We could go and look at net profit before tax. No, we'll do net profit. Net profit for the year is 2,000 divided by 31. Remember, there's only 4 marks for this. 1,300 divided by 25. So 2 divided by 31 is 6.45%. And 13 divided by 25 is 5.2%. So that's looking good. Yeah, okay. We could look at other things. Could look at admin expenses. Asset turnover. How many times are we turning our assets over? Well, if I'm going to carry on and think about omitting the deferred tax and my denominator in the bottom figure, 15,150, I've got 31,000 divided by 15,150, and that compares with 25,000 divided by, what was the figure? 4,025, 13,775. 31 divided by 15,150 is about 2 times, 2.04 times. Compares with 25 divided by 13,775, and that's 1.8 times. And the difference there is it's an increase of 10%. That's 10% improvement. So improvement there of just over 10% actually. 2.4 divided by 1.8. It's actually 13% improvement. Net profit percentage, again we can work that out on a comparable basis. 125 divided by 5.2 is an increase of, what is it, 24% improvement. Gearing. Borrowing compared, outside loans compared with that. So it's 4.1, and do I take in deferred tax or not? Am I borrowing that? I'm not really. I'm going to take 2.6 divided by equity, 12,550, and 4,025 divided by 9,750 divided by equity. So 2.6 divided by 12,550 is 20%, 21%. And 4,025 divided by 9,750 is 41%. And so we're far less dependent upon outside funding than we were. The asset turnover has been affected by this finance lease, but also the revaluation reserve. We've increased the value of the assets by 1350 in this case, net. If we had taken that out, then the asset turnover would have been a lot quicker. But we've got to include the 1350. So, what can we say? How can we interpret it? We've got a solid increase, a 17.4% increase in return on capital employed, where we're now returning 22.44 compared with 17.4, which is an improvement of 504 divided by, have I done that right? I've not done that at all. Return on capital employed is an improvement of 28.29%. Compared with 17.4, we've improved it by 29% to get to 22.44. So that's a solid increase. The question that is being raised when we're looking at return on capital employed is, are we getting enough return on our investment? And the answer would seem to be yes, we are. If we were to sell everything and put it in the bank, we certainly won't be getting 29% back on it. Gross profit percentage, yeah, you can increase your gross profit percentage by hiking your prices up, but if you do that, you do it at the risk of losing your speed of asset turnover. But in fact, we turned over our assets twice compared with 1.8, which is itself is an improvement of 13%, and we've managed to hold our costs down. If we look at the revenue compared with this year and last year, revenue itself, and remember we've only got 4 marks for this, revenue's gone up by 6,000. That itself is not going to score. But if I say 6 divided by 25, that's an increase of 24% increase in revenue, and our cost of sales has increased. Well, in theory it should increase by 24%, but it's gone from 18.6 to 21.8, which is 3.2. So 3.2 divided by 18.6 has actually gone up by only 17%. So not only have we improved our profitability in terms of gross margin, but we've improved our revenue faster than we've improved our cost of sales. It would suggest that Monty is in great control of its cost of sales figure. Either that, or there's been maybe a potential cut-off problem where we've overvalued our inventory. But it doesn't look like it, because inventory at the end of the year is 3.3 compared with 3.8 the previous year. Inventory days is substantially lower. I could work that out actually. Inventory days, 3.8 divided into 18.6, which is cost of sales, which is the best we can do, would tell me that that's last year, is 4.89 times, whereas this year we've substantially reduced it. 3.3 divided by 21.8, so the other way around, 21.8 divided by 3.3 is 6.6 times. So we're turning our revenue over 6.5 times a year every 2 months, whereas last year we were turning it over every 2 and a bit months. What is it? 12 divided by 4.89. That's 2.4 months. This year it's 12 divided by 6.6, which is 1.8 months, 1.82 months. So we're actually selling our inventory quicker at a better price, getting a better profit, and maintaining control over our cost of sales, which is really very good. Trade receivables, this is beyond the scope of the question now, but 2.2, that's last year, let's do it properly. 2,950 times 365 divided by 31,000 compares with 2.2 times 365. This is the number of days sales in receivables, and it's a bit of a silly calculation because these debtors include sales tax, whereas the revenue doesn't. But anyway, we are consistent in our calculation, so that times 365 divided by 31,000 is 34.7 days, which is collecting our debtors collecting money due to us rather quickly. 365 divided by 25,000, and that's 32 days. So that's not so good, is it? 32 days. Well, maybe we've increased our revenue because, just let me check those calculations, because we're offering a longer credit period. Maybe. That's 34 days. And that one is 2.2 times 365. 2.2 times 365 divided by 25. It's 24 days. That can't be right. 2.2 times 365 divided by 25 is 32.1 days. Yeah, maybe because we're offering longer credit period, that may be the reason why we're able to increase our revenue and still maintain control over our cost of sales. We could do the same exercise for trade payables as well. I don't know whether it's worth it because this is beyond the scope of the question. Distribution costs, again, beyond the scope of the question. Distribution costs have gone from 2.4 to 3.6. That's an increase of 50%. And our admin expenses, that's gone up 600 on 1,600. So 6 divided by 16, that's an increase of 37%. So although we're managing to increase our revenue disproportionately higher than cost of sales increase, distribution costs have gone up an alarming 50% for a 24% increase in revenue. They seem all right. We seem to be on top of it anyway. Tax expenses, as you would expect, it's actually a little bit more expensive last year than it was this year. Other comprehensive income is obviously the revaluation. The finance lease Interest, that has increased by 150%. It's gone up 150 on top of 100, and that's only for 9 months. It says on the 1st of July we acquired additional plant, and we're going to the 31st of March, so that's only 9 months worth of finance lease interest, so that's going to increase next year by the interest on the 1.5 million. And the loan repayment, that loan repayment, 8% loan, we paid off 1725, and we have loan interest of 250 last year, 150 this year. You can actually work it out. 8% on 3125 is for a full year. 8% is 250, which was the correct amount last year. So the 3125 was in existence the whole of last year. If we had repaid halfway through the year, that 1,700, that would have been 125 for a half year on the 8% on 3125, and then 8% on 1,400 for half a year is 56. That should therefore have been 181, and in fact it's 150. So we must have repaid that loan earlier than the half year, maybe even after a quarter of the year, after 3 months. That would be 62, and then 684, that would have been 146 loan interest. If we'd repay 1,700 after 3 months, and then we got 1,400 for 9 months, that would have given me the 146, and in fact the loan interest is 150. So it's about, after 3 months we repaid that 1725, 8% loan. The finance lease obligation, that looks good in terms of we're using other people's credit, we're using that finance leased asset, which was 1.5 million. And together with already our existing finance leases, but we seem to be using that to good effect to generate this increase in profits, and it's using somebody else's financing to help us do it. So I'm quite happy with that. Gearing, 2.6, where's my gearing? 2.6 over 12,550. Even if I include 16,650, 15,150. What have I done there? 12,550, that's over equity. If I'd done 2.6 over equity plus long-term loans, which 2.6, that would give me 15,150, and 4,025 over plus the long-term debt of 4,025, which is 13,775. If I work those out, 2.6 divided by 15,150, that's 17%, 17.2%. 4,025 divided by 13775. 4,025 divided by 13775 is 29%. So a lot less dependent on other people's financing. Again, if I go back up here to the cash flow, we can interpret some of this cash flow and say we are making enough from our operating activities to finance this development expenditure and the purchase of tangible non-current assets. Admittedly, we've bought some tangible non-currents under finance lease, but we are making sufficient here to cover our our investing activities. And even if we get down here, 1525, we've used this surplus operating net of investing activities, we've used a substantial part of that together with a substantial part of our 1,300 to finance this figure of 2,775, getting rid of this expensive borrowing. I think the company's doing very well. I think it's a very strong company. And the time now is 14:52, and that's just 45 minutes. But a lot of these are unnecessary. Look at them. Look at all these, even higher than that, isn't it? Return on capital employed, we've got that 1, 2, 3 pages worth of calculations, and that's only 4 marks. So that's disproportionate. You would have to be very, very careful not to get sucked in to this concept of I like playing with my calculator. Personally, I don't. You might have gathered that. But you must fight the desire to get stuck into calculating ratios when there are only 4 marks available for it.